Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
Okay, let's just look at the tape. The closing price on February 10th, 2026 was just over $225, specifically $225.26. And that is right up against the 52-week high hit that very same day. But the number that actually caught my eye wasn't the price, it was the volume profile. On January 30, we saw this massive spike to over 4 million shares traded against a daily average of just 1.3 million. That was followed by steady institutional accumulation and then a gap up of over 6% on February 6th. And for those not, staring at charts all day, a gap up is when the stock opens significantly higher than it closed the day before. It usually signals a rush of new information or, frankly, panic buying. The tape is telling us that Howmet Aerospace has effectively decoupled from the standard industrial cycle.
I look at that same chart and I see a warning light flashing bright red. I see the gap up, I see all the excitement, but we have to ask what exactly is being bought here. At $225 a share, Howmet Aerospace, ticker HWM, is trading at approximately 63 times its forward earnings. The market capitalization has swelled to $91 billion. Let's just pause on that. A 63 times multiple that's typically reserved for high-growth software monopolies, companies with zero marginal costs that can scale infinitely. We are talking about an industrial manufacturer here. They make engine blades and fasteners. So the central question we have to wrestle with today is whether this valuation reflects a permanent scarcity premium for a truly monopoly-like asset, or if investors are just ignoring the historical gravity that eventually pulls all industrial multiples back down to earth.
See, you're anchoring on the multiple, and I understand why. A 63 PE looks terrifying if you compare it to, a steel mill. But I think that misses the structural metamorphosis of this company. This isn't the old Alcoa or Arconic. Since the spinoff on April 1st, 2020, this stock is up 1,600%. That didn't happen by accident. They shed the low-margin aluminum commodity segments, all the heavy cyclical stuff, to focus entirely on the high-margin engine and fastening businesses. My thesis is that HWM is no longer a parts supplier. It's an aerospace infrastructure play. With the commercial aircraft backlog sitting at over 15,000 units, which is effectively 10 years of guaranteed work, investors are paying for visibility. I believe there is a mathematical path for this company to quintuple again, to a $455 billion market cap by 2036.
Whoa, hold on. A $455 billion market cap? You need to realize the sheer scale required to make that math work. For Howmet to 5x to $455 billion, it would have to become significantly larger than GE Aerospace is right now. GE Aerospace, their primary customer, the dominant engine maker in the world, is trading at roughly $344 billion today. So you're suggesting that a supplier, however critical, will eclipse the market cap of the company that actually builds the engines. I find that incredibly hard to swallow. It assumes the market will continue to award a 63 times multiple forever. If Howmet's growth slows from 10% to, say, 5%, and that PE compresses to a standard industrial 20 or 25 times, well, the stock price could stagnate for years even if the company executes perfectly. That is the definition of being priced for perfection.
Well, it sounds ambitious, I grant you that. But let's dig into that perfection argument. You're viewing this through the lens of a traditional, cyclical industrial, where you have a boom and then you have a bust. I'm arguing we are seeing a double tailing effect here. Howmet isn't just selling parts for new planes, they are profiting from the build rates of the LEAP and GTF engines, yes, but they also own the annuity-like aftermarket. As the global fleet flies more, they need replacement blades and vanes. These parts have a finite life. They literally burn up. This creates a floor for growth that standard industrials just lack. So it's not just a cyclical trade anymore, it's a secular compounder. And the market pays up for compounders because they remove the risk of having to time the cycle.
I agree the business model is excellent. My concern is entirely about the price you pay for that excellence. When you have peers like RTX trading at 31 times earnings, and GE Aerospace, the king of the hill, at 35 times, and Howmet is all the way up at 63, the air gets very thin up there. But let's break down your 5x thesis. You threw out that $455 billion number. Walk me through the actual arithmetic that gets us there from $91 billion today. How do the variables actually stack up?
Okay, to get a 5x return over 10 years, we need roughly a 17.5% annualized return. It sounds steep, but here is the framework. First, revenue. They are targeting about $9 billion for 2026. If we assume a 10% compound annual growth rate, which is consistent with the backlog and their pricing power, revenue hits roughly $23 billion by 2036. That's the top line.
Wait, let's stop there for a second. 10% compounded for a decade in an industry that's constrained by supply chains, labor shortages, geopolitical friction? That assumes zero interruptions. No strikes, no pandemics, no trade wars. But, okay, go on.
It assumes the backlog holds, which historically it has. But the second lever is margins. They are already at 29% EBITDA margins. Through automation and the mix shift toward those higher margin spares we just mentioned, I see a clear path to 35% margins. They are removing human touchpoints from the manufacturing floor every single year.
35% EBITDA margins for a manufacturer dealing with raw materials? That would put them in the same profitability league as some software companies. I mean, labor costs are rising, energy costs are rising. How do they expand margins by 600 basis points in that environment?
Automation and pricing power. They're the sole source for many of these parts. If they raise prices 4%, the customer pays it. But the third lever is buybacks. They've been aggressive, reducing the share count to around 408 million early this year. If they keep shrinking the float by 2 to 3% a year, we get down to about 300 million shares. So you put that together, 23 billion in revenue, 35% margins, fewer shares, and you're looking at an EPS potential of $15 to $18 per share.
I'm listening to the math, but there is a massive ghost in the machine here. You're building a model where everything goes right, but the exit multiple is the fatal flaw. Even if they hit that $18 EPS number, to get to a $455 billion valuation, the stock has to trade at 45 to 90 times earnings. In 2036, you are assuming that a mature industrial company a decade from now, when growth naturally slows due to the law of large numbers, will command a valuation multiple higher than NVIDIA or Amazon does today. That is dangerous speculation. Usually, as companies mature, their multiple compresses. If they earn $18 a share in 2036, but traded at rational 20 times multiple, the stock is $360. That's not a 5x return. That's a 50% return over 10 years.
You're treating HWM like a traditional metal bender that should trade at 20x. I'm arguing they are a monopoly on a specific type of physics. And this is where we need to talk about the moat. Look at the engine products segment, which is 55% of revenue and generating those high margins. We are talking about single crystal casting. This isn't just pouring metal into a mold, like you're making a frying pan.
I know it's complex, but is it really a monopoly? There are other foundries in the world.
Not like this. Inside a jet engine, the temperature exceeds the melting point of the metal itself. So to stop the blades from melting, they have to be cast as a single crystal. A normal metal object is made of millions of grains pushed together. Under heat and stress, those grains slide past each other. It's called creep. The blade deforms. Howmet grows the blade as one single continuous lattice of atoms. They do this in massive vacuum furnaces where the temperature is controlled within a fraction of a degree for weeks at a time.
Right, it's impressive engineering.
It's not just engineering, it's tribal knowledge. It's what they call black art. You can buy the furnace, but you can't buy the recipe for the cooling rates or the ceramic core mixtures. Competitors have tried. The Chinese aerospace industry has spent billions trying to replicate this specific single crystal process, and they still struggle with yield rates. This is a generational barrier to entry. And that is why I believe the multiple will stay high, because nobody else can do this at scale.
It's a formidable moat, I grant you that. The physics are undeniable. But technology moves fast. And I worry about the market reality versus the metallurgy. You're betting on casting remaining the gold standard forever. I'm looking at additive manufacturing, 3D printing. It is moving from prototyping to production at a velocity that is frankly scary.
3D printing is great for brackets and simple shapes. It's not replacing a high-pressure turbine blade anytime soon. The physics of the green structure just aren't there.
Not yet, but look at the trajectory. 5 years ago, we said 3D printing couldn't handle structural loads. Now it does. Right now, it's mostly non-rotating parts, but the tech stack is evolving with AI-driven design. If a competitor creates a printed blade that is 80% as good, but 50% cheaper and faster to produce, the airlines might push for it. And even if the tech holds up, look at the client concentration. Their revenue is tied inextricably to Boeing and Airbus. I mean, Boeing is struggling to ramp 737 MAX production to 53 a month. If there is a systemic failure at an OEM, or if the FAA grounds a fleet, Howmet's $9 billion revenue target for 2026 evaporates. You can't separate the supplier from the health of the host.
I'm not convinced by the 3D printing threat because Howmet is hedging that bet perfectly. They hold patents in additive manufacturing. They are using it to reduce their own tooling costs. But more importantly, the next leg of value isn't just casting, it's the material transition. We are moving towards ceramic matrix composites, or CMCs. The GE90X and the CFM Rise programs, the engines of the future, are going to demand engines that run even hotter. Metal, even single crystal metal, hits a physical limit. CMCs are the answer. If Howmet dominates the CMC supply chain the way they dominated superalloys, the value density per engine doubles. They are the heat-resistant spine of global aviation. That's why the client concentration doesn't worry me as much. Boeing and Airbus literally cannot build a plane without them. They have the leverage, not the OEMs.
They can't build a plane without titanium either, and that brings up another risk: supply chain. A huge portion of the world's titanium sponge comes from Russia and China. I know Howmet is vertically integrated. They make their own ingots, but they still need raw feedstocks. A total cessation of global trade or a blockade is a tail risk that would shatter that 10% growth projection. But let's pivot. We need to talk about how they are using their cash right now. The math you used earlier relies on smart capital allocation. Let's talk about the CAM acquisition.
Absolutely. This is a masterclass in capital allocation. They bought Consolidated Aerospace Manufacturing, CAM, for $1.8 billion. On the surface, that sounds like a lot, but let's look at what they actually bought.
They bought fasteners, nuts and bolts.
Not nuts and bolts from a hardware store. These are engineered fastening systems that hold an airframe together under supersonic speeds and intense vibration. Once a fastener is certified for an airframe, it is almost impossible to switch it out. It's a classic razor and blade model. They are getting $490 million in revenue and sole source parts with very high switching costs. And because of the tax benefits involved in the deal structure, the effective price paid is only about 13 times EBITDA. That is immediately accretive, meaning it adds to earnings per share from day one. Plus, their balance sheet is a fortress. Net debt to EBITDA is at 1.1x. They bought back $200 million in stock in Q3 of 25 alone while making this acquisition. It's a magnification effect, growing the top line while shrinking the share count.
Well, that's the press release version. But let me offer a more cynical take. When a company with a sky-high stock price starts buying other companies, I have to ask, is organic growth stalling? Look at the forged wheel segment. It's the cyclical outlier here. Revenue grew only 1% in Q3 2025, and volumes actually dropped 16%. Why? Because truck build rates are down.
Wheels are a small part of the pie.
It's a barometer for the industrial economy, though. Are they buying CAM to mask the fact that the cyclical parts of their business, like wheels, are rolling over? It's easy to hide slowing organic growth by purchasing revenue. And while the credit upgrade to BBP Plus is nice, they are leveraging up to buy assets at what might be the top of the aerospace cycle. If we have a recession next year, paying 13 times, even with tax benefits, might look expensive. History is littered with industrial companies that made big acquisitions at the peak of a cycle and spent the next 5 years writing them down.
I think focusing on the forged wheel segment is missing the forest for the trees. Yes, truck volumes are down, but even with volumes down 16%, they maintained a 29.6% EBITDA margin in that segment. That shows incredible operational discipline and cost flexibility. They aren't buying CAM to mask weakness. They are buying it to deepen the moat. CAM gives them pricing power in a new vertical. And regarding the cycle, with a 10-year backlog on aircraft, we aren't at the top of the cycle. We're in the early innings of a super cycle. Airlines are flying older planes longer, which helps spares, and they are desperate for new fuel-efficient planes, which drives OEM builds. It's a win-win.
Supercycle is a dangerous word in investing. It usually implies that this time is different. I want to go back to the valuation relative to peers because this is where the rubber meets the road for me. You mentioned the backlog effectively guarantees revenue, but the market knows this. That's why the stock is at 225. That's why it's at 63 times earnings. The good news is already priced in. If you buy today, you need a Goldilocks scenario for the next 10 years. You need perfect execution, no supply chain wars with China, Boeing to fix its production issues seamlessly, and CMCs to be adopted without hiccups. And if they execute, that's the problem. If they execute perfectly, the stock might grow into its valuation. But if any one of those things breaks, if there's a hiccup in the CMC transition or a recession and the multiple compresses from 63 times down to a normal 30 times, do the math. You lose 50% of your capital overnight. The company could still be profitable, still paying dividends, but the stock price crashes because the premium evaporates. That is the risk.
I see the risk, but I believe the Technology and Markets Day on March 10 is going to be the catalyst that proves the multiple is justified. They are going to showcase the R&D pipeline, specifically the propulsion tech. Historically, these events de-risk the long-term narrative for institutions. It shifts the conversation from how many bolts did you sell this quarter to how critical are you to the future of flight? The market is paying a premium for certainty in a chaotic world.
Certainty is expensive. And right now, it's priced at a premium that implies Howmet is more of a tech software firm than a manufacturer. I'm looking at the chart, seeing that vertical move in early February, the gap up. It feels like FOMO, fear of missing out. The volume spike to 4 million shares tells me everyone is crowding into the same trade. When everyone is on one side of the boat, I get nervous.
But that volume also shows conviction. It's not just retail traders on their phones. It's institutional accumulation. The floor at 204 to 208 held firmly during the retracement. That tells me the big money, the pension funds, the sovereigns, is defending the position. They see the path to $15 EPS. They see the share count dropping to 300 million. They see the margins expanding to 35%. The math supports the move, provided you believe in the durability of the aerospace recovery.
And that is the crux of the disagreement. We both agree it's a high-quality company. The operational excellence is undeniable. But as we wrap this up, my position is caution. The investment case at 225 plus requires that perfection. The primary danger for new money entering now is that valuation compression. If the growth rate ticks down even slightly, the punishment will be severe. My advice to anyone listening is to watch the spares revenue specifically. If that aftermarket annuity slows down, the thesis breaks, and that 63 times multiple will collapse.
That's a fair metric to watch, but I'll conclude with this. Looking at PE is the wrong metric for a company dominating a generational supercycle. You have to look at the annuity of the installed base. Every engine delivered today is a revenue stream for the next 20 years. The March 10 event will likely confirm that Howmet is a compounder, not a trade. In a world of geopolitical tension and supply chain fragility, the company that makes the heat-resistant spine of global aviation commands a permanent premium. I believe the path to a $455 billion market cap is paved with single crystal alloys and pricing power.
We shall see if the market agrees in 2036.
Indeed. That does it for this edition of The Debate.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.